Pring Turner Quarterly Newsletter, July 2014. Grateful for the first half of 2014 and looking forward to the second half. Pring Turner clients enjoyed strong returns in the second quarter and once again reached all-time highs in wealth, adjusting for any deposits and withdrawals. That makes new highs for portfolios in 13 of the last 15 very challenging years. Grateful for the market strength, we are also mindful of typical market behavior in the later stages of the business cycle. Late in the cycle, inflation begins to accelerate, and our portfolio tactics gradually adjust to these changes. We are prepared to both navigate the challenges and take advantage of the opportunities in the second half of 2014. Middle East tensions historically have a direct impact on energy prices and, consequently, inflation expectations and investment portfolios. One responsibility as conservative investment managers is to determine the implications of Mideast turmoil and proactively position portfolios for the consequences. For the U.S., the best defense is to grow our own production and become less dependent on Middle East oil. In our October 2013 newsletter, we highlighted the game-changing implications of the U.S. oil renaissance. We suggested the ongoing energy boom would significantly reduce dependency on foreign energy, add hundreds of thousands of jobs to our economy, initiate a U.S. manufacturing rebirth, and improve the balance of trade payments. Our portfolios are benefiting from this tremendous global shift in energy production, and we continue to search for quality beneficiaries of surging domestic oil and gas production. Last quarter's newsletter pointed out financial markets are trying to identify a clear winner in the battle between the forces of inflation and deflation. The latest Consumer Price Index data released in mid-June shows prices climbed 0.4% in May alone. That equates to a nearly 5% rate on an annual basis, with recent gains accelerating. Indeed, energy, food, shelter, healthcare, and other consumer prices continue to firm up, adding credence to budding inflationary concerns. Adding to recent CPI data is an important economic indicator, the U.S. capacity utilization rate. Capacity utilization is simply the percentage of factory usage. This measure typically alerts to changes in direction of inflation. The most recent reading at the end of May 2014 is 79.1, meaning plants are running at close to 80% of capacity. Historically, readings approaching 80 in this indicator argue that inflationary pressures will begin to build as we use up idle capacity and the economy continues growing. After 5 slow growth years for the economy, we are finally starting to feel the effects of higher prices, and that has implications for investments. Inflation is a lagging indicator for the economy that typically later in the business cycle. Recent firming price behavior is rational considering how far along we are in this cycle. We believe the continuing leadership trend in inflation-sensitive securities will be durable. This year's overall portfolio outperformance is due to both persistent stock market strength and the healthy exposure to inflation beneficiaries such as energy and precious metals sectors in your portfolio. As we pass the halfway mark of 2014, we are pleased with your portfolio performance given the numerous challenges facing the markets. Our disciplined business cycle investment strategy is designed to help you navigate the risks and rewards of the markets. While grateful for past years of adding value to your wealth without taking undue risk, we also remain vigilant and on alert for any signs of a major turning point in the markets that would change our tactics toward more caution. As always, please feel free to contact us should you have any questions regarding your portfolio or changes in your personal circumstances.